Hello, this is Camille. I'm presenting What's in Your Investment Portfolio? Strategizing by Analyzing. And this is for Finance 695, Project 2. So, I want to strategize for a win. We all look forward to retirement, and I anticipate the day of retirement. And I want to be prepared for that day, that season. So just like a good football coach have a strategy in anticipating a winning season, a good strategy can assure a win or a profit when investing. Now, let's think. We want to learn, think, and invest. When I began investing in a 401k plan, I initially placed all monies in a guaranteed fund. My thoughts were, well, if the market crashes, I have at least part of my money. Honestly, since I've completed a finance course, my thoughts have actually changed. When I think about risk and return, risk can be good or bad. Thus, the risk of an investment should draw just as much concern as the return on an investment. In the beginning, there were 18. 18 companies were analyzed to determine the one company to invest in. In order to accomplish this goal, 17 companies had to be eliminated. So what did I do? I began this process by placing companies within a specified industry. Identified industries. Based on the companies to be analyzed, 7 industries were noted, and they are as follows: engineering, oil and gas, manufacturing, health services, telecommunications, technology software, and beverages. Now it's time for the elimination process. The first thing I did was I determined the company's historical performance. Has the company consistently performed well as compared to other companies in its industry? Look at the company's return on equity, at least for the last 5 years, because 1 year is just not enough time to make an informed decision. And what the return on equity does is it reveals the rate at which shareholders are earning a return or income on their shares. The return on equity is sometimes referred to as the stockholders' return on investment, and it's calculated by taking the net income and dividing it by the total equity. Now it's time for round 1. During the first elimination process decisions, the following companies with a negative return on equity were eliminated, and they were Amedisys Incorporated, Tenet Healthcare Corporation, and CenturyLink Incorporated. Companies with a negative profit margin were also eliminated, and this included one company, and that was Gentiva Health Services Incorporated. So why is a positive profit margin important? Well, again, profit margin is calculated by taking the net income and dividing it by sales. And yes, high profit margins are ideal. The profit margin is an indication of profitability for a company. And of course, it is often used as a way to measure the effectiveness of a company's business model, especially within the same industry. Additionally, the profit margin provides an indication of how well a company is setting its products prices and controlling its production costs. Cutting costs results in higher profit margins. Moving on to round 2 of the elimination process. A falling or declining return on equity was the next variable utilized to make this second round cut. The return on equity declined from 2009 to 2013 for the following companies, and they were Community Health Services Incorporated, Jacobs Engineering Incorporated, URS Incorporated, Autodesk Incorporated, Fluor Corporation, and Coca-Cola Inc. Now we're moving on to round 3, still continuing our elimination process. And the thing that I looked at was the economic value added. And a positive economic value added means a current project was given a good return on their investment. And as such, companies with a negative economic value added for 2013 were eliminated. 2 companies met the criteria for elimination in the 3rd round, and those were Caterpillar Inc. and Marathon Oil Corporation. Moving on to round 4, times interest earned ratio. The times interest earned ratio is listed in our profitability ratios. This ratio indicates the extent of which earnings are available to meet interest payments. A lower times interest earned ratio means less earnings are available to meet interest payments, and that the business is more vulnerable to increases in interest rates. Only one company qualified or met this criteria, and that company had a declining times interest earned ratio, and it was CB&I, Chicago Bridge and Iron Company. Well, look at this. I'm still standing. So far, 13 companies have been eliminated. Now, 5 remain. And they are Deere & Company, Valero Energy, Intuit, Monster Beverage, and AT&T. As I moved into round 5, companies with a current ratio below 1 that are declining since 2009 were eliminated, and those were Deere & Company and AT&T. The current ratio calculated as, well, you can calculate the current ratio by taking the current assets and dividing it by the current liabilities. And this is an indication of a firm's market liquidity and its abilities to meet the creditor's demands. If a company's current ratio is between 1.5 and 3, it generally indicates a good short-term financial strength. However, if the current liabilities exceed the current assets, or the current ratio is below 1, then the company may have problems meeting the short-term obligations. Likewise, if the current ratio is too high, then the company may not be efficiently using its current assets. Say it ain't so. Valero eliminated. Valero Energy was cut because the price to earnings ratio decreased from 2010 to 2013. And basically what the price to earning ratio is the ratio of the company's current share price to its earnings per share. It gives us an idea of what the market is willing to pay for a company's earnings, but it also indicates how the stock is valued in the market. So if you look at the graph that's reflected, we have the Valero price to earnings ratio. Looking at it at the beginning in 2010, their prices was a little above 14, right at 15, but it really declined sharply in 2011, and it gradually increased and it stabilized. Even though it stabilized, it's not worth what it was in the beginning, because if you notice, it's like right above 14, and now it's stabled off to maybe like $8.50, $9. So this is why I eliminated Valero. That leaves me with 2 companies standing, Intuit versus Monster. Now, there are a lot of things about Intuit that I like. Their ratios look great, but my concern was software companies are constantly changing, and in my opinion, they tend to be a little volatile and sometimes they're unpredictable. Monster, on the other hand, is a stable company. It has much growth potential, and I guess my main point is focusing on investing in what I know. Not only that, I think that it brings a special touch to the market. So let's talk about Intuit. It's more liquid. They have a rise in profitability. They have inclining market values. They have effective asset management. And we can see this through its increase in a total asset turnover. And it's not to take anything away from Intuit. All of these things are good. But you know what? Even with all these good points, I'm just not into it. Let's talk about Monster. Monster Beverage Corporation. It has a good asset turnover. Their rise in return on assets and return on equity is quite noticeable. Their market values have increased since 2009. They also have a positive economic value added, and their operating efficiency increased. So, in conclusion, I chose Monster Beverage Corporation due to my familiarity with the brand and the strength of the company in this industry. And because I'm not a big risk taker, Monster Beverage Corporation is a good fit for me. It has shown a positive direction for profitability. And I prefer the bargain hunter style of shopping that reflects a practical attitude. Investing early can prove to be a touchdown retirement. Thank you for taking the time to listen to my presentation.